this is a topic that you have been a leader on talking about. I think it was, 2 years ago? It wasn't 2 years, right? Or was it 2 years where you talked about this idea. It's a pig making its way through the python, and we're not there yet. Still, it's been 2 years of LPs asking for their money back. Volumes are still down. The SaaS-pocalypse certainly didn't help. I mean, has this whole thing just been set back? Are we going to just be kept waiting for this digestion period to finally finish?
Yeah, I think that's the right way to think about it. The pig is literally moving through the python. Maybe it's 2 years ago it was in the abdomen. Now it's sort of moving a little bit further down. But yeah, there was 10 plus years of 0% interest rates where sponsors went on a buying spree, paid ever increasing prices for assets, generally good assets, but now they're stuck holding these things. The inventory, as you alluded to, of private equity owned companies is really, really high. And it's tough to exit those companies at valuations that sponsors in general want to sell at. And so, yeah, I think we are somewhere still mid-river, waiting to get to the other side.
I had a banker make the comment to me the other week that it just shows that something about private equity is broken because it's a promise. You give me money, I buy an asset, I sell it, I return. And public markets have been really robust. They're at all-time highs. As I mentioned, strategic M&A has been really high, too. So what has gone wrong? I mean, is this a promise broken for this industry?
I would say I think the industry lost its way a little bit. I've been pretty vocal on that. The industry was founded on finding good assets, pay a reasonable price for it, operate it better. When interest rates went to zero and stayed there for a decade, the equation changed to find a good asset, don't screw it up. What you paid for it didn't really matter because at 0% rates, valuations always went up. When all of a sudden, in 2022, 2023, we saw rates move 500 basis points, that changed everything. I'll make a shameless plug for Apollo here, but this is where, fortunately, we didn't get the memo that the cycle was going to last a decade and stayed very disciplined on valuation, and as a result, we've been actually pretty active selling and exiting companies.
And did things like avoiding software. I mean, you mentioned higher rates. We're going to get CPI today. The odds have now shifted to a rate hike in the United States, certainly here in Europe, too. Does this just exacerbate the problem even further?
Well, exacerbated if you thought rates were coming back down. I think we've been pretty vocal that rates were going to stay at these levels for a while because we didn't see the economy slowing down. We didn't see a need for rate cuts, and I think that's probably where things are headed.
So we're going to get some mega IPOs. SpaceX this week. We learned that OpenAI is filed for an IPO. We don't know when we'll get that. Anthropic's going to be coming soon. Do these big IPOs, is it helpful for this industry? Does it open up the gates to allow people to exit? Or is it we're all competing for the same institutional capital, and unless you're SpaceX, it's a bad environment to go public?
No, it's a little bit different. Again, this is not about the ability to exit. We've done 4 IPOs in the last year, several sales. There's capital available. It's just you may not like the valuation that's being offered. So if you've paid a reasonable price going in, you can get out in this environment. If you've paid a high price going in, well, you're kind of stuck. Most of the assets that private equity owns are not SpaceX or Anthropic. And so when you look at, the S&P setting new records, every other week, it's a dozen companies, right? It's not, the 490. And it's certainly not the next 2,000 companies. Most of those companies are trading at pretty, reasonable or modest valuations, which is why the new money environment for making private equity investments is pretty attractive right now. We've certainly been active. Others have as well. You mentioned volumes are down slightly for new M&A, but it's still a pretty robust environment for making new investments.
Again, it's just the exit picture that we're stuck on. So what eventually happens? Is there something that happens to this industry that we say, okay, we need to come to terms with this. We need to take a valuation hit and just sell that stuff. And what prompts that if that does happen?
Yeah, the passage of time, right? So as long as there's not an intervening recession, these companies are accreting in value, and you get closer and closer to your target valuations, even if multiples have come in. And so each year that passes, you will see.
Does that make it harder to exit, though? Because they get bigger. So your options of where you sell this company are more limited.
No, in the grand scheme of things, what it means is you're generating cash flow, you're paying down debt, you're creating more equity value, and you're approaching that target MOIC Now, your hold period is extended, and so that's impacting IRRs, and so you are seeing IRRs come down in the industry for that 17 to 22 vintage. But no, with the passage of time, you'll see it. But yeah, folks are going to have to start capitulating, for sure.
What does capitulation look like? Is it painful? Is it a reckoning?
Well, I think you will see a shrinking of just the expansion of private equity firms that you saw over the last 10, 15 years. You'll see firms raise smaller funds. You'll see some firms go away. That's just the nature of the cycle. Yeah, for sure.
A lot of this current private capital cycle, too, a lot was pinned on the hopes of democratization, of more retail funds. Very much so private credit story. It kind of leaked into private equity with the latest on Partners Group and their Evergreen fund. I just wonder if that's part of the conversation here, too, that we've rethought that as the next pillar of growth for the industry.
Yeah, look, Apollo's been very vocal. We have not brought a retail private equity fund because we just haven't thought that's sort of the best asset for that asset class. And so for the very reasons that we're seeing in private credit, at least in private credit funds have maturities, debt have maturities, so you get your money back eventually if you move into a withdrawal cycle. In private equity, as we've seen, it's been 3 or 4 years with depressed monetizations. That could be pretty painful in a retail type product, and so we've been cautious on that. We know others have pushed into that. We've tended to stay away in a wealth or semi-liquid private equity product.
Do you think that's kind of the next evolution of this? Again, we kind of saw echoes of that, but it starts with private credit, but now you have retail rethinking exactly for the reasons you're saying about their holdings in private equity.
Look, remember, limitations on the semi-liquid funds withdrawals is a feature, not a bug, right? It's meant to protect the rights of redeeming investors and remaining investors. And so you will always see the ebbs and flows of that in a product like that. It's not a bad thing or a good thing. It just is. It's just the media makes a lot of hay out of that when you hit those points.
So it's our fault, Scott. I see where this is going.
No, but the point is it's a different type of product.
Right.
But yeah, you will absolutely see those points in the cycle for wealth private equity products just like you do in wealth credit products.